Be sure to catch the entire video to get insights into the possibility of a market fall and how you can use gold and silver as your financial safety net. Good day, Luxo lovers! Today, we'll be discussing the possibility of a market downturn and strategies to navigate through it successfully. But first off, we want to express our gratitude for choosing to spend your time with us at Luxo-Life, your partner towards success. Luxo-Life is all about achieving success in various aspects of life. We're here to assist you on your journey. Let's start by breaking down what we mean when we talk about a potential market fall. Essentially, a potential market fall, also known as a market downturn or correction, is when the overall value of financial markets takes a significant hit. This includes everything from the stock market to the bond market and other types of investment. It's a period where the prices of most assets start to drop, and that often brings about a sense of uncertainty and financial strain for investors. These downturns can range from minor blips to more extended and substantial declines. To put this into real-life terms, let's look at a recent example. Think back to the 2008 global financial crisis. It's a prime illustration of a potential market fall. During that time, a range of factors, like the housing market crash and numerous bank failures, triggered a severe market downturn. Stock markets worldwide took a nosedive, resulting in significant losses for investors and causing economic hardships far and wide. That crisis drove home the importance of being ready and having a well-diversified investment strategy to weather the storm when faced with challenging market conditions like these. Let's dive into the critical topic of market indicators and signs of a potential market fall. Several key indicators and signs are currently pointing towards the possibility of a market decline. These signals serve as valuable barometers for market health and can help investors make informed decisions. First and foremost, the recent performance of major stock market indexes is a noteworthy sign. When these indices show sustained declines, it typically indicates a waning confidence among investors and the potential for a market correction. The red numbers on these indexes can act as an early warning system for those keeping a close eye on the financial landscape. Another significant factor influencing market dynamics is the Federal Reserve's stance on interest rates. The decision to maintain higher interest rates for an extended period can have a substantial impact on precious metals like gold and silver. Historically, these metals have thrived in low interest rate environments because they offer an attractive alternative to traditional investments such as bonds. Conversely, when interest rates are held high, the opportunity cost of holding gold or silver increases. Therefore, it's making them less appealing to investors. This can exert downward pressure on the prices of these precious metals. Additionally, it's crucial to consider the ripple effect of the Federal Reserve's actions on the banking system. Programs like the Bank Term Funding Program, which have seen a surge in emergency funding, raise concerns about the state of the banking sector. The fact that the collateral provided to the Federal Reserve often falls significantly short of the amount borrowed underscores potential vulnerabilities in the financial system. If the Federal Reserve were to withdraw emergency assistance, the specter of bank failures could loom larger, exacerbating the risks associated with a market downturn. Continuing our discussion, let's dig deeper into the banking system and emergency funding, particularly focusing on programs like the Bank Term Funding Program and what they mean for our banks. When we see these emergency funding programs, like the Bank Term Funding Program, dishing out huge sums, it's like a big flashing warning sign for the health of our banks. One critical thing to note is the gap between the value of the collateral banks are handing over in exchange for emergency cash and the actual amount they're borrowing. The difference is a red flag signaling potential trouble lurking in the assets banks are holding. While these programs provide a short-term lifeline and much-needed liquidity, they also make us wonder just how stable those banks really are. Now let's shift gears and chat about what could happen if a bank bites the dust. The impact goes way beyond the bank itself. Banks are the engines that keep our economies running smoothly, facilitating loans, credit, and the flow of money in financial markets. If one goes belly up, it can set off a chain reaction of financial turmoil. People might lose faith in the whole banking system, leading to bank runs and a massive liquidity crisis. This in turn can put the brakes on lending to businesses and regular folks, leading to economic slowdowns and job losses. What's more, our world is super connected these days. A bank failure isn't just a local problem, it can send shockwaves through international markets. Governments usually step in to prevent these catastrophes with bailouts or other rescue plans, but they often come with a hefty price tag for taxpayers and can mess with the economy for a long time. So the bottom line is, the health and stability of our banks are mega important, not just for financial markets but for how we all make a living. Let's move on to the next topic, which is the national debt and deficit, and how they tie into the overall economic picture. This stuff is crucial to understand because it impacts our wallet and the future of our country. So when we talk about the national debt and deficit, we're basically looking at how much money the US government owes and how much it's spending than it's taking in. And boy, have those numbers been climbing lately. The implications of this growing debt and deficit on the US economy are pretty hefty. For one, it means that the government is borrowing more and more money to cover its expenses, which can lead to higher interest rates in the long run. That in turn can make it more expensive for people and businesses to borrow money, which can slow down economic growth. But here's another angle to this: the interest payments on the national debt. As the debt pile grows, so do the interest payments the government has to make. In fact, if things keep going at this rate, the interest on the national debt alone could become one of the biggest line items in the federal budget. That's a big deal because it means less money is available for things like education, infrastructure, and other critical services. Moreover, when interest payments eat up a big chunk of the budget, it can lead to difficult choices like cutting spending elsewhere or raising taxes. These actions can have ripple effects across the economy and can be a hot-button issue in political debates. And let's not forget the risk factor here. If the national debt keeps ballooning, it can potentially make the US more vulnerable to economic shocks. Investors might start worrying about the country's ability to pay back all that borrowed money, and that could lead to higher interest rates and a drop in the value of the dollar. It's kind of like a financial snowball effect, and it's something we need to keep an eye on. Now let's segue into a fascinating topic: gold and silver as safe havens. When we're talking about economic ups and downs, these shiny metals have a special role to play. You see, when the economy hits a rough patch, people often turn to physical gold and silver as safe haven assets. These metals have a reputation for being a financial sanctuary during turbulent times. Why, you ask? Well, it's because they tend to hold their value when other investments like stocks might be taking a beating. You can think of them as the financial equivalent of a lifeboat when the economic shift is navigating choppy waters. One of the key reasons folks consider investing in precious metals is their ability to act as a hedge against inflation. When governments start printing more money, as they sometimes do during economic crises, it can lead to the devaluation of currency. In simple terms, your dollars might buy you less. That's where gold and silver come in. They have a track record of maintaining their value over the long haul. So people invest in them to help protect their purchasing power. Another thing that makes gold and silver attractive is their tangibility. Unlike stocks or bonds, you can hold these metals in your hand. There's something reassuring about having a physical asset you can touch and feel, especially when economic uncertainty is on the horizon. Plus, it's a bit like a form of financial independence. You're not relying on a third party like a bank or a company to safeguard your investment. And it's not just about economic crises. Precious metals have a timeless allure. They've been used as a store of value for centuries, and that history adds to their appeal. In times of uncertainty, this historical track record can provide a sense of stability and reassurance. But it's not all smooth sailing in the precious metals world. The video touched on how the prices of gold and silver can be influenced by factors like interest rates and market sentiment. So while they have their advantages, investing in these metals also comes with its own set of considerations and risks. Let's keep this discussion rolling and move on to the topic, Costco selling gold bars, and how it connects with the public's increasing fascination with precious metals. So when you hear about big retailers like Costco diving into the gold game, it's actually pretty significant. It's like a signal flare that the appeal of precious metals is stretching beyond the usual crowd of investors. Costco selling gold bars shines a spotlight on the fact that everyday folks are getting curious about these shiny assets. The availability of gold bars at a well-known store like Costco make it more accessible and could lead to more people considering them as part of their investment portfolio. Now let's talk about mainstream media coverage. When the news outlets start talking about gold and silver, it can have a profound impact on their popularity. Mainstream media has the reach to introduce precious metals to a broader audience. When people hear about these metals on the evening news or read about them in their favorite newspapers, it can spark interest. It's like the media is putting a giant spotlight on these assets, and it tends to draw more folks into the conversation. However, it's essential to approach this with a balanced perspective. Media coverage can sometimes create hype or overstate trends. When that happens, it can lead to a herd mentality where everyone rushes in because they don't want to miss out. That kind of frenzy can sometimes lead to exaggerated price movements and isn't always based on solid fundamentals. So while mainstream media can pique interest, it's vital for folks to do their own research and to understand the risks and rewards of investing in precious metals. In the end, the fact that retailers like Costco are offering gold bars and the media is talking about precious metals speaks to the growing curiosity and interest in these assets. They're no longer confined to the realm of niche investors. However, as with any investment, it's crucial for individuals to approach it with a clear understanding of their financial goals and to be discerning in their decision-making process. Okay, so now let's keep the conversation flowing and shift our focus to the historical use of silver as money and how it ties into our modern financial system. Silver has quite the illustrious history as a form of money. It's been used as currency for centuries across various civilizations. In the past, coins made of silver were not just tokens, they had intrinsic value because of the metal itself. This historical role as a trusted medium of exchange has left a lasting legacy. Even in our modern financial system, silver plays a vital role, though it's no longer in everyday circulation. Instead, it's seen as a precious metal and a store of value, much like its shinier sibling, gold. Now let's talk about the recent drop in silver prices against the backdrop of a financial system that's seen its fair share of turmoil. When we see silver prices falling, especially during times of economic uncertainty, it can be a bit puzzling. One potential reason behind this is the broader market sentiment. During times of crisis, investors may opt for the safety of cash or government bonds, causing a decrease in demand for precious metals like silver. This can lead to a drop in prices as investors look for liquidity and stability in more traditional assets. Another factor at play is the broader state of the economy. When the financial system faces turbulence, it can lead to a decrease in industrial demand for silver. Silver is not just a precious metal, it's also used in various industries, including electronics and solar panels. So if economic activity slows down, it can result in reduced industrial demand for silver, putting downward pressure on its price. Additionally, market dynamics, speculation, and trading sentiment can also influence the price of silver. Traders may engage in short-term buying and selling, causing price fluctuations that aren't necessarily reflective of the metal's long-term value. It's like a tug-of-war between short-term speculators and long-term investors, and that can lead to price swings even in times of economic uncertainty. It may sound like a handful, but stick around because we're diving into the topic of inflation and economic impact and how it connects to our financial well-being. Inflation is something that affects us all, so understanding what's behind it and how to navigate through it is pretty darn important. Now, when we talk about rising inflation, it's like the cost of living gradually cranking up a notch. There are various factors at play, and it's not just about prices randomly going up. Factors like increased demand for goods and services, supply chain disruptions, and yes, even the amount of money circulating in the economy all contribute to inflation. When these elements push prices higher, it can erode the purchasing power of your hard-earned money. So how does all this affect the economy? Well, for one, it can make everything a bit pricier from groceries to gas. If your income doesn't keep up with these rising prices, it can feel like you're treading water while the cost of living keeps pulling you under. It can also impact savings and investments, as the real value of your money might diminish over time. This can be a real concern for folks looking to protect their assets and maintain their purchasing power. Now let's talk strategies. When inflation rears its head, there are a few moves you can make to help safeguard your financial well-being. One classic approach is to invest in assets that historically have performed well during inflationary periods. Precious metals like gold and silver, which we discussed earlier, are often seen as hedges against inflation. Real estate and stocks in sectors that tend to benefit from inflation like energy and commodities can also be good options. Additionally, consider adjusting your budget and spending habits. This doesn't mean you have to tighten the belt dramatically, but being mindful of where your money goes can help. Focus on saving more and look for ways to invest in assets that can keep pace with or outpace inflation. And don't forget about the power of diversification. Spreading your investments across different asset classes can help cushion the impact of rising prices on your overall portfolio. Now let's dive into the nitty-gritty of preparedness strategies, building on what we've just talked about regarding the impacts of inflation and how it can affect our financial stability. The speaker in the video had some valuable recommendations for us, and it's all about being proactive and ready for whatever curveballs life may throw our way. First off, securing essential supplies is a smart move. We're talking about the basics like food, water, and necessities. Having a well-stocked pantry and emergency supplies can be a real lifesaver during unexpected events, whether it's a natural disaster or economic turmoil. It's like having a safety net for you and your family, so you're not left scrambling when things get tough. Now let's chat about protecting your assets. The speaker emphasized the importance of assets like precious metals, which tend to hold their value during financial crises. But it's not just about investment, it's about safeguarding what you've worked hard to accumulate. This can include diversifying your assets, having an emergency fund, and ensuring you have proper insurance coverage. It's all about making sure you're not putting all your financial eggs in one basket. And let's not forget about exercising your rights. This part of the speaker's advice is about being informed and engaged in your financial decisions. Understanding your rights as a consumer, investor, or taxpayer can be empowering. It means you can make informed choices and protect your interests. This might include staying informed about financial regulations or advocating for transparency in the financial industry. Now, the big picture here is having a well-rounded preparedness plan. It's like having a financial safety net that covers not just your investments but your everyday needs too. When you combine securing essential supplies with protecting your assets and being informed about your rights, you're taking a holistic approach to being prepared. It's about being proactive and ready for whatever twists and turns the future might hold. Building on our discussion of preparedness strategies, let's dive into the fascinating and somewhat controversial realm of price suppression and manipulation in precious metals markets. This topic ties directly into the concerns raised in the video about protecting one's assets and the potential consequences of market manipulation. So here's the deal. There have been long-standing concerns about price suppression and manipulation in the gold and silver markets. The worry is that these markets might not always reflect the true supply and demand dynamics, thanks to various factors at play. Some argue that powerful interests may try to influence prices artificially, potentially keeping them lower than they should be. When this happens, it can affect the perceived value of these precious metals and impact investors' decisions. Now, what are the potential consequences of such manipulation? Well, it can create an environment of uncertainty and mistrust in the markets. Investors rely on market prices to make informed decisions, and when they suspect manipulation, it can erode confidence. Additionally, if prices are artificially kept lower, it may discourage people from investing in precious metals as a hedge against economic turmoil, potentially leaving them more vulnerable during a crisis. Moreover, it's not just about individual investors. This manipulation can have wider economic implications. If the prices of gold and silver are kept artificially low, it might affect the overall stability of the financial system. These metals often act as canaries in the economic coal mine, with their prices reflecting broader economic trends. So any distortions in their pricing can make it harder to gauge the true state of the economy, which can have far-reaching consequences for businesses and policymakers alike. Now let's continue our discussion by exploring some options and considerations in purchasing precious metals. When it comes to buying precious metals, you've got a variety of routes to choose from. Besides dedicated dealers and mints, local coin shops can be a valuable resource. They often have a range of options, and you can establish a personal rapport with the owners, which can be reassuring. Auctions and online marketplaces are another avenue, but they can sometimes carry higher risks due to the potential for counterfeit items. So do your homework and ensure you're dealing with reputable sellers. Now let's talk about the forms of precious metals you can purchase. You've got choices like gold coins, bars, and silver rounds, each with its own advantages. Coins can be easier to trade and might come with collective value. Bars, on the other hand, often have lower premiums over the spot price, making them attractive for investors looking to maximize their metal holdings. Silver rounds are an affordable way to start building your precious metals portfolio. Since we're already knee-deep in the world of precious metals, let's take a peek into the crystal ball and speculate about the future of their prices and their evolving role in our economic landscape. Now, predicting the exact future prices of gold and silver is like trying to forecast the weather a year in advance. It's a tricky business. These metals can be influenced by a myriad of factors, from economic trends to geopolitical events. But one thing's for sure, they've shown their resilience time and again. In times of uncertainty or economic turbulence, the demand for safe haven assets tends to rise, and that often includes precious metals. So they might continue to play a valuable role in portfolios as a hedge against economic volatility. Of course, with opportunities comes risk. Like any investment, precious metals aren't immune to market swings. Price fluctuations can be influenced by factors like interest rates, market sentiment, and even the strength of the US dollar. And let's not forget about the potential for market manipulation, which we touched upon earlier. So while gold and silver can offer stability, it's essential to approach them with a clear investment strategy and a long-term perspective. And that wraps up our discussion, Luxo lovers. We hope you found this conversation insightful and thought-provoking. If you did, show us some love by hitting that like button, leaving your thoughts in the comments, and sharing this discussion with your fellow Luxo lovers. And if you're new to Luxo-Life, you can hit that subscribe button and ring that notification bell so you can stay in the loop and never miss out on our future insights. Thanks for tuning in, and until next time.